Welcome back to our SaaS event today. We will now be joined by OrderYOYO CFO Jesper Hyveled and CEO Jesper Johansen. Sorry that I have had so many events with you that I didn't remember your name. As always, you can ask questions in the box down below. We will take the Q&A in the end, but I will now hand the word over to you, Jesper.
Thank you, Michael. And thank you for having us. Great to be here and present our company. Yes, I'm Jesper Johansen, and Jesper Hyveled is next to me. So a brief presentation about OrderYOYO. So if you start with the first slide, Michael. So we are the European market leader in the white label market for systems to takeaway restaurants. Now, next slide, Michael. Now, what does that mean? That means that we actually, and this is our purpose and it's been from day one, we liberate restaurants. We ensure restaurants, takeaway restaurants, that they are able to service and cater for and own their own customers to the benefit of the restaurant itself, instead of giving this ownership away. And why is that important? Next slide, Michael. This is because that in a typical takeaway restaurant, up to 90% of orders are recurring orders from loyal customers. Now, right now, a lot of these orders are handled by portals, and that is a problem for two reasons. Number one, it gives the ownership of these recurring customers away from the restaurant itself. And number two, it's extremely costly. So a portal would charge between 15 and 35% of an order for executing an order for a restaurant, whereas if the restaurant goes through us and have their own system, they will be charged between 5 and 10% by us, and more importantly, they will strategically own their own customers. So when that customer returns, the restaurant will be the owner, not the portal. This has been our value proposition from day one, an extremely important purpose that actually saves restaurants, and this is why we have our overall purpose of liberating restaurants. Now, next slide, Michael. Now, for us, it's all about the order. In the middle of our system, we have our shop system, which is digital orders, driving digital orders. Now, this is basically a web shop and app that enables a restaurant to take their own digital orders. On top of that, we ensure that the restaurant gets both new and existing customers through our marketing and loyalty product. We make sure that their end users is able to pay and use all payment technologies available to execute the order. And we make sure that the restaurant has the ability to operate their front of house, so all the stuff relating to the order. This includes a POS system that we just recently acquired from AppSmart and that we redeveloped and relaunched during 2023. All this creates a lot of stickiness and ensures that our 11,000 restaurants stay with us and keep growing in our system. Next slide. So our business has been growing quite extensively since the years just before COVID. So in Q1 19, our GMV, so the gross merchandise value going through all of our partner restaurants, were 536 million Danish kroner. And this has grown in last quarter to more than 4 billion through our system on an annualized basis. So we have more than 7.5 times bigger now than we were 5 years ago. Next slide. Now, one of the reasons for that is our firm and strong strategy on becoming a European market leader. We are number one in Europe, and we are that by going deep in the biggest market in Europe, UK and Germany. And on top of that, we're number one in Ireland, Northern Ireland, Austria, and Denmark. Size matters a lot in this industry, and size makes sure that we are able to grow and that we're able to make money, all to the benefit of our restaurant partners and to the very end to our shareholders. Next slide, Michael. We grow organically. We've done that historically quite successfully. And on top of that, we are growing through M&A. So we have two types of consolidating transactions that we've been doing. We've done 3 transactions over the last 3 years. When we enter new markets, we would like to do that by acquiring number 1 or number 2 in a given market. We did that when we acquired AppSmart in 2022. And we acquire in existing markets where we want to acquire bolt-on acquisitions that we will make sure can deliver a lot of profitability. So a more cost-driven acquisition. This is what we did in April of 23 when we bought Kingfood in UK, and when we acquired Gustoco in November of 23. Strong growth case with a path to profitability that is kicking in now. Over to you, Jesper, on the financials. Next slide, please.
Thank you. And next slide, please, Mike. So looking at our growth since 2018 in our annual recurring revenue, we have 10x'd our total annual recurring revenue to almost 300 million by the end of 2023. That has happened both organically and through acquisitions, as Jesper just mentioned. We are a firm believer of growing with our restaurants, and that is what you see in these numbers. We have a product that is tailor-made for growing, and that is scalable, and we are able to do much more for on the same products as we have today. Next slide, please. Now, one of the things that is as important as revenue growth for us is our strong EBITDA. So our ability to grow profitable is a key strategic imperative for us. We've been able to deliver high growth and ensuring a very, very good profitability over the last quarters, something that we are very proud of, and that has happened through a constant important strategy look at this for us, and then obviously the M&A, where we're able to benefit from synergies as soon as we add the acquisition into our company. Next slide, please. So our guidance on EBITDA has been raised several times throughout 23, and we are seeing the same in our 2024 guidance, meaning that our original guidance between 9 and 11% in EBITDA margin has been raised to between 15 and 17% EBITDA margin. Now, the ability to be able to deliver these profit margins is due to the fact that we have a constant focus on our profitability. We do only invest in product activities that will generate growth both for the company itself, but also for our restaurant partners. So everything we do is focused on generating revenue for either our customers or for OrderYOYO as such. And with revenue and profitability on OrderYOYO, we are able to invest even further in our product offering to the restaurants. Our long-term EBITDA goal is 25%, and we are not far from that with the latest raised 2024 guidance. So we are keen on delivering that number not too far from now. Next slide, please. So here a little bit about the details on our raised 2024 guidance. The ARR and net revenue raised since the initial guidance provided for 24 back in October 23. ARR between 325 to 335 million, and a net revenue just below 300 million. Our GMV between 3.3 and 3.4 billion in 2024. Now, this is not to compare with the 4 billion that Jesper mentioned initially. That is only the 3 billion that we ended 2023 on. On EBITDA between 43 and 48 million, and our cash EBITDA between 15 and 20. Cash EBITDA here is EBITDA subtracted our capitalized R&D expenses. So also on cash EBITDA, we are looking at a fairly solid margin for 2024, and something that we also are growing in the years to come. Next slide, please. So Jesper, I'll hand it over to you on the
Yes, thank you.
Final slide.
So just a final slide that concludes this presentation. So we went public in 21 and obviously had guidance for 21, 22, and 23. To kind of make a final loop around that, we've just tried here to highlight the realized numbers that we did for 23 compared to the IPO targets that we had in our prospectus back in 21. So back in 21, our GMV target was between 3.7 and 4 billion. Now the realized we had was 4.1 billion, which includes the POS GMV that we have in Germany. The ARR that we had as IPO target for 23 was 275 to 300 million. We did 296 million. On EBITDA, we had a target of 20 to 25. We did 26 million. And the number of FTEs, we actually had a target of being 431, and we've been able to realize the numbers that we have with just above 200 employees. And then on top of that, freelancers of around 50 freelancers. Now, what this all boils down to in terms of profitability is, and as an example, on the left side of the slide, we've tried to show you how the scalability in this business is by looking at our R&D spend as a percentage of the net revenue. So falling from 30% in 21 to just around 12% in 23, delivering a superior product. And this is what software as a service is all about. Growing and being a large player with an ARR of almost 300 million ensures that we can scale and that we can be much more efficient than we were when we were at 100 million. Next slide, Michael. Q&A. So over to you, Michael.
Yeah, but perfect. Let's start with the overall question. You know, you have gone extremely fast to profitability and are actually targeting to go very fast on this road still. So how do you balance growth versus profitability? Could you actually invest more of your profitability into growth, or is this kind of the best way to utilize your model through M&A instead of this, or would you cannibalize too much on your current investment if you invested more? So a little bit of thoughts about the very fast movement you have to profitability. Is it a choice, or is it the best way to actually generate returns?
Good question, and obviously this is the strategic path that we have decided together with our board of directors to follow. Now, the initial thoughts about strong profitability and going through towards that was actually to be able to take own decisions, so be leaders in our own house. And you only in an interest rate environment going up and a financial world, especially towards SaaS companies in terms of funding going down, you only do that by making sure that you are cash positive. So very early on, we decided that we wanted to be a master of own destiny. And the only way you are that is by being cash positive. So that was number one, and reason number one why we did this. Number two, I don't think that we originally have jeopardized growth in this industry, in this company, by being focused on profitability. On the contrary, actually, it makes you sharp. It makes you prioritizing in a much harder and better way. And it ensures that the culture in the company is that you need to make profitable growth. So in that sense, I do not believe that we are jeopardizing or have been jeopardizing growth because of profitability. On top of that, our M&A strategy is driving both profitability and growth. Now, this is looking back. Looking forward, so the current strategy will keep on focusing on profitability, and we will keep on delivering that. It's very important for us, both in terms of inorganic and organic growth. Now, could there be situations where you could actually spend some of your profits to further increase growth 2 or 3 years down the line? Maybe, but this is obviously always a delicate and difficult decision to take, because you have to invest and use short-term gains for longer-term gains. So it's a balance that we keep on discussing all the time. But up until now, I do not think that we have jeopardized growth in any shape or form. Anything to add?
No. Echo.
Perfect. And then a little bit about the market situation. We have seen Fodora moving out of the Danish market. How does the competitive situation look like across your markets?
Fodora was a fairly small portal in Denmark. I think that Wolt and Just Eat were much bigger, so it hasn't affected us, to be very honest. And I think that the situation is in all markets basically the same. You have one or two strong portals that are competing on the end user part of the equation. Now we are not seeing ourselves competing with these portals as such, but obviously we are targeting the same end users. In terms of white label producers and POS producers. So the white label producers, what we see in all markets is small local players, typically cheaper than us actually. But on the net, we outgrow them and win more than we lose to these smaller competitors because of our superior product and our superior organization. POS players, again, local players we mainly see. We do not see the big players. They are attacking larger restaurants, dine-in restaurants and chains, whereas there's no one really servicing the quick service takeaway restaurants as we are.
And then there's a question, can you continue to take market share and outgrow the market? You know, you have had a 10x revenue. You have actually grown very strongly the last couple of years where market might have been flat. Maybe I think you indicated last time that you're starting to see some market growth. But is it your expectations and your future expectation that you can continue to outgrow the market growth?
I think the opportunity is there. Remember that even though that we are at 300 million ARR, so approximately 1 million orders a month, so 12 million orders a year, this is still only a fraction of a gigantic market. The takeaway industry and takeaway market is gigantic, and we're only scratching the surface. So there's a lot to do for us still. And the ability and the opportunity to take market share is definitely there. It's all in our hands.
And a little bit about the food portals, because I guess I think you have said earlier that they have been a little bit more focused on profitability like you have, but that has actually hampered their growth because they are buying a lot of customers, right? Are you seeing any changes in their behavior that might affect you? Or I know you're not competing directly with them, but at some point in time you are competing about the order at the end of the day.
I think we're the picture from our side towards the portals are the same. But what we have seen, especially in the last quarter, is actually that where they've been totally flat to downward, they're actually a little plus in terms of growing. We've seen that, which I think is a market trend more than anything. So we use the portals more as a proxy for the market than anything else.
Then are you investing in AI? Do you see any changes from the AI wave in the market you're operating in?
So let me just start a little bit, and then Jesper will take over because this is actually some of the stuff that's happening in his department. Yes, we are actually using AI or machine learning or neural networks, or what you can call this. There's no doubt that the ability for us to qualify leads, make sure that we help our restaurants at the right time is something that we can use AI to, and we're actually doing that. But I'll let Jesper talk a little bit about that.
Yeah, so we are using AI or machine learning, and we also have projects on the product side that are looking into this. So it's definitely something that we see, and it's also something that we've been using, for a little more than 2 years plus live. So inventing and developing on this going more than 2 years back. So we are very data heavy company, and we uses our data to make qualified decisions on, and that obviously leads towards the use of AI, and we have materialized that already, and we have several projects both in our you can say commercial excellence. So the way we operate, we are using AI tools. But on the product side, we are also inventing and looking into new ways of making this more intelligent.
So if I should understand you, you have used it internally to drive up your efficiencies, and right now you're looking at trying to find a way to implement it into your product offering, and also taking, the big data capture. I guess there must be a lot of orders and a lot of knowledge actually to be taken out of this. So is that how I should understand it? That is what you are now looking at, how you could integrate it into products?
Yes, and on the product side, a traditional example is that if you're before AI, they would recognize you as a user, and then they would suggest your last purchase or something that is a favorite within the restaurant. That you can sophisticate many times with AI, and that's something that is being assessed and developed right now as we speak.
And then with the M&A being a big part of your strategy, can you still, how is the market out there? Can you find targets out there that are on your multiple the same or lower as your multiple? Because I guess that's also been a part of, you might, if there's a really strong strategic direction, but you also indicated that you kind of want to keep it at the same multiples or lower as your own. So how is that developing your pipeline and so on? Are you still seeing any, you might say, traction on those multiples that will actually give you the right return?
So I won't comment on multiples as such for specific deals, but M&A is an important and integral part of our strategy. We are very outbound. So we are searching for the companies that we want to acquire, and we're still doing that. And the pipeline is as healthy as it has been. Sometimes it takes a little longer. Sometimes you can do an M&A transaction quicker. And importantly, I should say, Michael, we want to do it around our own multiples. Now, does that mean that if there is a strategic important acquisition where we need to pay a little more because the synergies are gigantic, would we do that? Probably, but you will never see us pay through the roof multiples for anything, unless we are, very high priced ourselves and we are paying with shares.
Perfect. I actually think we both got through the presentation and a lot of questions on time. So thank you to you, Jesper and Jesper, for taking us through the presentation and answering questions. And we will take a short break. In around 7 minutes, we will be back with the next presentation.
Thank you.